As a former JP Morgan analyst, I know one thing for sure. Mastering financial modeling isn't just a skill, it's a game changer for your career. But where do you start? Let me walk you through top 5 financial models every finance profession should know. And there's this three statement financial model, your foundation for all the analysis. Then the DCF model, where the cornerstone of company valuation takes place. For the IPOs, you will need the IPO model. For the merger model is a must. And finally, LBO model, a favorite part in private equity. So, want to know how these models can transform your career? Let's break them down together. So let's get started by understanding the top 5 types of financial model. And they are, the first one is the three statement model. Second is called as the DCF model or the discounted cash flow model. Third one is the IPO model. Okay. Fourth, we have is the merger model. And fifth is the LBO model. So now that we know what are the 5 types of financial models, let's get started by understanding, how and what are they used for. So here we have a three statement financial model of McDonald's. Okay. So what's the objective of creating a three statement model? First thing first, three statements are nothing but the three financial statements: income statement, balance sheets, and cash flows. Okay. The objective here is that, for example, in this case, McDonald's, the objective is that you basically figure out what the historicals are, right? So they are already provided to you by the company's management via annual reports. Now, with the help of the historicals, you figure out what the projected figures would look like. So, say for example, here you see that, okay, we have this data for the last 5 years, and you can go about projecting the next 5 year period based on what has happened historically. Okay, so when it comes to a three statement model, we are saying that you need to understand and assess what is currently going on as well as historically what has happened, and based on that, come up with your estimate on how the income statement, balance sheets, and cash flows will look like in the future. So that's why they're called as forecast, right? So not just the income statement, but also the balance sheet, as you can see here in this model, as well as the cash flows. Now, the thing is that it's not as easy as it sounds like when it comes to the projections, because in these three statement financial models, the approach is to be like when you change a certain set of assumptions at one place, this financial model should completely work on its own. So, what is needed here is that we create different schedules like the revenue built up, where we go about projecting McDonald's revenue in this case, and it is a very detailed exercise, right, as you can see here. Likewise, you have a cost sheet as well, and you figure out what the cost will look like, and all the assumptions which we are taking here is basically based on the historicals. So we see what has happened historically, and then based on that we make certain assumptions and then figure out how the future years would look like. So same goes for cost, and then you go about projecting each and every line item when it comes to balance sheet as well as cash flow. So it's a very detailed exercise, by the way, and the most important and a comprehensive one as well. And this is where, it's called as a three statement financial model with the objective of understanding a certain company. So you can replace McDonald's with Netflix, you can replace McDonald's with Tesla, but the objective of three statement financial model would be like, you have the historicals and you need to understand how the company's financials will look like in the future. So you create a integrated financial model which works on its own, and it has certain assumptions in place which has to be managed professionally. So that's what a three statement financial model does. It helps us figure out how the company will look like and its financials in the future. Okay, so let's get to the second one, and that is the DCF model. Okay. And for now, I would like you to look at these steps here in the discounted cash flows. The first one was projecting the financials. So this is where your three statement financial model sits, right? So you projected McDonald's financials. Okay. But after projecting McDonald's financials, and let's say if you are an equity analyst or an investor, you would like to understand whether you can invest in McDonald's stock or not. So this DCF model primarily will help you understand what is the fair value of McDonald's. And there are certain steps associated with it, right? Like there we have 7 steps written here, but the broad idea would be to figure out on the basis of forecast what is the free cash flows that the company would generate in the future and discount those cash flows to find out the present value. So here again, it's a very rigorous exercise where you first do the projections, like the creating the three statement financial model, which you do from scratch. Like in the case of McDonald's three statement financial model, we saw that it was a very rigorous exercise. So once you are done with that, you figure out what's the free cash flow to the firm, and then you also find out the discount rate. Here we call that as weighted average cost of capital. And this is again a very robust and a professional exercise that you must perform. And once you are done with all of these, you come up with the share price, that is the fair price of the company. And depending on what is the ongoing price in the market, you basically suggest a buy or a sell on that stock. So that's the outcome of this DCF model. It helps us understand the intrinsic value of the company. So that is the second type of financial model. The third one again is a very interesting one. We call that as a IPO model. So here we have Coursera IPO model. We created this long time back, and the objective was that when Coursera was coming up with its IPO, it came up with the price band, right? That this is the range in which they will list the company. So if you are an investor, you need to understand whether you should go about investing in Coursera's stocks or not, right? So if that's the objective, again, you will do the same exercise. You will have to figure out how the financials of the company looks like historically, and then you go about projecting the financials, and then you do the fundamental analysis, figure out how the company looks like. And basically, all in all, what you're trying to do is to understand this company thoroughly. So you're creating a three statement financial model, and then you are also performing the valuation analysis on this. So if you look at this DCF valuations, you can see that the objective of this model was to come up with the final fair price at which you can invest in Coursera. So if the price band is above what you have got in terms of fair value, then you should not invest in Coursera, right? So again, this is a very rigorous exercise, and people keep on working on this IPO model, especially if you are a equity analyst or investment banker. You would need to create these type of models. Okay. The fourth one is again a very interesting one that we call that as merger model. Now, what do you understand by a merger is that there are two companies. So in this case, we have Alpha Tech and Beta Electronics, right? So we call Alpha Tech as acquirer here in this, and Beta Electronics as the seller, okay, or the target. Now, if Alpha Tech is acquiring Beta Electronics, then how this overall scheme of things will pan out? Is it good for the acquirer or not? What are the type of synergies that you can look for? What are the returns that the company can expect over a period of time? So all that analysis is basically done in the so-called merger model. And the basic recommendation when it comes to merger model is that how this merger should be handled. So should Alpha Tech pay all cash to Beta Electronics, or maybe Alpha Tech can use a part of stock to give it to Beta Electronics and part cash? So in what proportion? So if you look at this model again, it's a advanced type of financial model, but the objective remains the same, that how will the company's financials will look like on a combined pro forma basis, whether the financials are accretive or dilutive. That means whether it is good for the company in terms of profitability, or it's adding value or not, or what are the type of ownership that can you expect once the merger happens. So all of that analysis comes under this recommendation from the M&A model. And if I have to just show you this, you can always understand this a bit later, but broadly this is a very rigorous exercise, and it needs some advanced knowledge of accounting, especially the purchase method of accounting is needed for you to figure this out. And you also need an understanding of how to create a financial model for this. So this is a merger model. Okay. And the last one, which is again a very important one, and again one of the advanced types of financial model, and this is called as a LBO model. Okay. And what happens in LBO model is very similar to what we already discussed in a merger model. So here what will happen is that one, not company, but maybe a pool of investors will take debt and acquire another company. Okay. And once they do that, so as the word suggests, leveraged buyout. So you're taking debt to buy out a company. And going forward, obviously, if you're taking debt, you have to repay the debt as well, right? So in this type of financial model, you try to figure out how much maximum amount of debt can you actually take. So, like for example, there is this LBO transaction. We created a case study on that, and this was about Delta Foods. Okay, and you can see that the acquisition was majorly via debt, and that was around 71.9% of the overall acquisition was financed by debt, and that's why it's called as leveraged buy out. And in this type of model, you basically figure out whether you are passing all the covenants, you are honoring those, if your debt to equity and other type of ratios are under control or not. So all of that analysis are also done in this. And apart from that, again, from investors point of view, how much is your proportion of investment apart from debt, and how much is the ROE or the equity return that you can expect over the next 5 years or 6 years or 7 years or so, when you basically sell this company to maybe someone else via IPO or via another acquisition. Now that you understand the top 5 types of financial model, and if you want to learn financial modeling as a skill, then I have two most important resources for you. The first one is this website, wallstreetmojo.com, which we have created with so much of love. We've invested a lot in terms of creating this resource on financial modeling where we cover all the basics. You have all the articles related to financial modeling, from the basics here to taking it to the advanced level. And in fact, if you look at this article as well on financial modeling in Excel, we have taken a company, Colgate, we downloaded the annual report and then created the financial model from scratch. So I would recommend highly that you have a look at these complete resources, and I will share these links in the description box below as well. So this is the number one resource that you should definitely look at to learn and expedite your journey in financial modeling. And the second one, which is that we have or we do provide a lot of courses on financial modeling, and I would recommend you to have a look at some of the self-study courses where we have created professional tutorials. Since we come from the background of being an analyst at JP Morgan and other places, we have mastered these concepts and put them via tutorial format. So this is something which you can also look at. And if you are looking for something more immersive, you can also look at live classes that we provide. So that is something, again, super useful if you are wanting to need, if you want some help from the instructor, you want to ask questions, you can also do so in this immersive live classes, right? So with this, we come to the end of the video. I hope you understood the top 5 financial models you need to know, whether it is a DCF or a LBO or even building a 3-statement financial model. These are your go-to tools to level up in finance. Honestly, financial modeling is like a Swiss Army knife for finance world, right? And once you get a hang of it, there's no stopping you. And I guess you enjoyed this and learned something new in this video. And if you did so, please give us a thumbs up. It really helps. And don't keep all this knowledge to yourself, right? Share it with your friends who are into finance too. And before you go, hit the subscribe button and turn on the bell icon so that you don't miss any of our future videos. We've got so much of cool stuff coming your way, and trust me, you will want to be here for it. Thanks for hanging out, and I'll see you in the next one. Until then, keep crushing it in financial modeling.